can a single company really turn every standard smartphone on the planet into a satellite phone?
Yeah.
Completely eliminate mobile dead zones forever? That's the audacious question we're unpacking in this deep dive into AST SpaceMobile Inc., ticker symbol ASTS. And this isn't just about, like, improving connectivity a bit. They want to fundamentally re-architect it, transform the sky into the ultimate cell tower. It's a huge technological ambition, right? Success means bridging the digital divide for billions. Failure means succumbing to these immense technical and financial challenges.
Exactly. And our mission today is to really dissect the components of this monumental undertaking, specifically for you, the investor. We want to help you determine the true balance of risk and reward here from a long-term, value-oriented perspective. What's fascinating right off the bat is that the market's current valuation, it's around $44.35 a share as of June 19, 2025. While it already suggests a significant degree of future success is priced in, that's a critical starting point for our discussion.
Yeah, good point. So we're going to break down everything you need to know about ASTS, from its innovative business model to its pretty formidable competition and its unique financial landscape. This is undeniably a high-risk, high-reward proposition. By the end of this deep dive, you'll have a clear understanding of exactly why. Oh, and before we jump in, just a quick note. If you're finding these deep dives valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. Plus, members paying €4.99 a month get priority deep dives on the tickers they suggest in the comments. So that's a great way to get your questions answered and influence our next topic. Okay, roadmap time. To give you a clear path for today, we've structured this deep dive into two main parts. Part 1 will cover Chapter 1, Business Analysis, Chapter 2, Management Evaluation, and Chapter 3, Financial Analysis. Then in Part 2, we'll pivot to Chapter 4, Market Sentiment, Chapter 5, Ownership Structure, Chapter 6, Risk Assessment, and finally our Chapter 7, Conclusion. Sound good?
Sounds perfect. Let's get into it.
Okay, let's kick things off then with Chapter 1, Business Analysis, the quest for ubiquitous connectivity.
Right. So at its core, AST SpaceMobile operates on a unique wholesale model. It's business to consumer, or B2B2C. They don't sell directly to you, the end user. Instead, they partner with established mobile network operators, MNOs, worldwide. Think the big players: Vodafone, AT&T, Rakuten.
And this is where it gets really interesting for those MNOs, doesn't it?
Yeah.
ASTS's service lets them integrate satellite connectivity seamlessly into what they already offer. So their subscribers, nearly 3 billion of them combined, can get access in places where normal cell towers just don't reach. It's designed to leverage those huge existing customer bases, right? Saves ASTS a fortune on trying to sign up customers directly.
Precisely. For the MNOs, it means potentially hitting 100% geographic coverage without spending billions building towers in the middle of nowhere. It disrupts their traditional infrastructure rollout. And that model flows into revenue. Projections show it'll be dominated by wholesale MNO capacity and revenue sharing deals. We're talking over 90% once they're fully operational. But there's also a secondary stream, and it's becoming more important. Government and defense agencies, like the U.S. Space Development Agency. These contracts bring in early cash, sure, but they also act as this powerful validation of the tech's robustness and security. That's a big signal for investors.
And the product itself, it's just this one thing, the Space Mobile service.
Yeah.
They're touting it as the first and only space-based cellular broadband network, offering 4G LTE and 5G directly to standard, unmodified mobile devices. That unmodified part is key.
It absolutely is. The goal is to make switching between a terrestrial tower and a satellite totally invisible to you, the user, truly eliminating those mobile dead zones. The potential scale is just immense. Agreements are already in place with around 50 MNOs, and technologically, well, their commercial Block 2 Bluebird satellites are going to feature these massive antennas, 2,400 square feet phased array antennas.
Whoa, that's huge.
It is. Among the largest ever planned for low Earth orbit. They're essentially giant, electronically steerable antennas in space. That size and tech are crucial because they need to focus a signal powerful enough to reach your existing phone directly from orbit. That's a unique engineering challenge and a core differentiator.
So breaking it down, what does this mean for everyone involved?
Yeah.
For MNOs, it's that 100% coverage dream without the massive capital cost. For you, the end user, it's finally getting rid of those infuriating connectivity gaps, like your phone working on a mountain or out at sea.
Right. And for governments, it offers resilient, secure communications that don't rely on vulnerable ground infrastructure. You can see the national security appeal there. And if we zoom out, look at the bigger picture. The global space economy is projected to hit, what, $1.8 trillion by 2035, driven hugely by satellite data demand. This direct-to-device market is a whole new frontier. Think about it. 4.4 billion people globally still lack reliable internet.
Wow.
ASTS is essentially aiming to turn every one of the world's 5 billion existing mobile subscribers into a potential customer. The addressable market is just staggering.
But, okay, they can't be the only ones thinking about this. Who are they up against? The competition must be heating up.
Oh, absolutely. It's heating up rapidly. SpaceX's Starlink is the most significant competitor, no doubt. They're leveraging that massive existing satellite constellation to get into the direct-to-cell market.
Yeah, you hear a lot about Starlink.
Their initial services are lower bandwidth, though, more like texting and maybe slow data. But their scale, their launch capability, their pace of innovation, it's formidable. ASTS's key differentiator, they argue, is that their system was purpose-built from day one for broadband direct-to-cell, aiming for speeds closer to what you get on the ground.
Okay, so broadband focus is their angle against Starlink. Who else is out there?
Well, you've got Amazon's Project Kuiper, huge backing, definitely a long-term threat, though maybe a bit further behind on direct-to-cell specifically. There's even speculation, about Apple maybe developing its own proprietary service eventually.
Apple. Interesting.
And then there's Link Global. They're a direct competitor, but reports suggest they're focused more on 2G speeds, not the 4G, 5G broadband ASTS is targeting.
So it raises a question, doesn't it? Will we see different tiers, like basic satellite texting from one provider, full broadband from another? How will that market share shake out?
That's exactly the question. And this MNO-dependent model, it's really crucial here. It's their greatest strength, like you said, avoiding those customer acquisition costs. But it's also a potential vulnerability.
How so?
Their success is deeply reliant on those MNO partners actually marketing and selling the service effectively. There's a big dependency risk there. Their reach is only as good as their partners' push.
Got it. Okay, what about the rules,
Yeah.
the regulations? Space is complicated.
It's a maze, yeah. International law, national laws. But ASTS has made really substantial progress. They secured a special temporary authority from the FCC, which was important. Even more critical, though, was a settlement with Legato Networks in early 2025.
Legato. What was that about?
It essentially grants them long-term access to 45 megahertz of premium lower mid-band spectrum right here in North America.
Yeah.
That spectrum is like beachfront property for wireless signals.
So like securing a dedicated highway lane.
Exactly. It's a crucial communication highway in a key market. Getting that locked down significantly reduces a potential bottleneck. It's a major de-risking event for investors, truly impactful.
Makes sense. So it sounds like getting into this business is hard. The barriers to entry must be huge.
Exceptionally high. Think billions in capital. ASTS has already sunk over $584 million into this. Then there are the massive technological hurdles, the intellectual property. ASTS boasts over 3,650 patent claims protecting their tech.
Wow.
Plus, navigating the regulations we just talked about and just getting reliable access to rockets for launches. It all adds up.
Which leads to their competitive advantage, their moat, right?
Exactly. While AST isn't a household name, they cleverly leverage the brand strength of partners like AT&T and Vodafone. That helps. They're also pushing for 95% vertical integration, making almost everything in-house. That aims for cost advantages and gives them tight control over their supply chain.
And network effects too, I suppose. More MNOs join, the service gets better, harder for partners to leave.
Precisely. Powerful network effects build over time, increasing switching costs.
But you'd say the deepest part of their moat is that IP portfolio and that locked-in spectrum access.
Arguably, yes. That combination, especially the North American spectrum, is very hard for competitors to just replicate quickly.
So they claim to be the first and only for broadband to unmodified phones. It's a bold strategy. High risk, high reward. If they pull it off, the moat looks wide. If they get delayed,
Simpler competitor services, even lower bandwidth ones, might grab that early market share. The clock is ticking.
which brings us perfectly to Chapter 2, management evaluation, because execution is everything here.
Absolutely central, especially for a pre-revenue company like this. The founder and CEO, Abel Avelin, he does have a proven track record. He founded and then successfully sold his previous company, Emerging Markets Communications, EMC, for $550 million. He's also an inventor on 24 U.S. patents.
Okay, so he's built and sold a relevant business before. That definitely helped de-risk things somewhat.
It does. It shows he can navigate this complex industry. And the company has managed that tricky transition from R&D into manufacturing and towards commercial deployment. That's a big step.
And attracting those big strategic investors,
Yeah.
AT&T, Google, Vodafone, that's more than just cash, right? It's a massive vote of confidence.
A huge vote of confidence, yes. But there's a counterpoint worth considering.
Okay.
While a villain's success with EMC is impressive, EMC was mainly a services provider. ASTS is building an entire global infrastructure from the ground up. The scale, the complexity is just vastly greater. Success in one domain doesn't automatically guarantee it in another, much harder one. The execution risk remains monumental. Don't underestimate it.
That's a fair point. So how is management communicating this challenge? You mentioned they project extreme confidence.
They do. Regular updates, CEO stating they're at an inflection point, expecting meaningful revenue in 2025. Very bullish public stance.
I sense a but.
But you look at insider transactions, and over the last 6 to 9 months, there's been this consistent pattern of stock sales by key insiders.
Oh, exactly.
The president, the COO, the CTO, the people really deep in the day-to-day engineering, the deployment challenges, they're consistently selling personal shares. It creates this dissonance, Strategic partners putting money in, but top operational leaders taking money out.
That doesn't sound great. What should we make of that?
It's a potent cautionary signal. It suggests that those who have the most intimate knowledge of the true difficulty, the real timelines, are choosing to diversify their personal wealth. It's something investors really need to weigh.
Okay. What about how they're using the money they do have? Capital allocation.
Oh, that's crystal clear. 100% of available capital is going straight into the core business, designing, building, launching the satellites. Like we said, they'd already incurred over $584 million in capitalized costs by Q1 2025. It is purely a build the thing story right now.
No dividends or buybacks then, obviously.
No, and that's entirely appropriate for where they are. Pre-revenue, capital intensive. Return on invested capital, ROIC. Deeply negative right now. But the bull case hinges on massive future operating leverage. Once the network's up and running, the potential for very high ROIC is there, theoretically, high efficiency at scale.
And you mentioned something earlier about financing, non-dilutive.
Yes, that's a really crucial recent development. They're securing over $500 million in financing from quasi-governmental bodies like the U.S. Export-Import Bank, XEM.
Why is that significant?
Because it's not equity, it doesn't dilute existing shareholders as much. It's also a powerful vote of confidence from sophisticated institutions that do serious due diligence. It's a shareholder-friendly move and another key inflection point.
Right, that's a lot on the business and management. Let's turn our attention now to Chapter 3, Financial Analysis. The numbers.
Right. So as of June 19, 2025, AST SpaceMobile's market cap is sitting around $12.6 billion.
$12.6 billion for a pre-revenue company.
Exactly. That valuation isn't based on anything they're earning now. It's entirely a forward-looking bet on absolutely massive future potential.
And revenue-wise, practically zero for the core business so far.
Minimal, like $4.42 million in all of 2024. Chump change relative to the valuation. But the critical turning point is supposed to be the second half of 2025. Management is guiding for $50 million to $75 million in revenue for the full year 2025.
Okay, so that's the signal everyone's watching for, the start of actual commercialization.
That's the first big test, yes. And because there's no real revenue yet, all the profit margins are, well, deeply and structurally negative. In 2024, for example, they reported an operating loss near $243 million. Net loss over $300 million.
Ouch. That highlights the cash burn, doesn't it?
Starkly. Significant and ongoing cash burn just to build this thing out.
And free cash flow reflects that too, I assume.
Absolutely. Tells a clear story of intense capital investment, consistently increasingly negative, over negative $300 million in 2024. That's the operating losses combined with those massive capital expenditures for making and launching the satellites.
So stability-wise, they're losing money, but they raised cash recently.
Right. Consistent losses since going public, totally expected given the plan. But their current ratio measuring short-term assets versus liabilities is exceptionally strong right now, over 10. That's driven by a big cash balance, nearly $874 million as of March 31st, 2025, thanks to those recent financing rounds, including the strategic investments.
So good short-term liquidity, but it's a snapshot. That cash is being spent.
Precisely. It provides a runway, but the burn rate matters hugely.
Still, how on earth do you value a company like this? Traditional metrics like price to earnings are useless.
Completely irrelevant with negative earnings. For a company where all the value is tied up in future prospects, a discounted cash flow analysis, a DCF, is really the most appropriate framework. It's all about the future.
Right, DCF. Forecasting future cash flows and discounting them back.
Exactly, but it hinges entirely on your assumptions. And for ASTS, those assumptions are huge. You have to project revenue growth, think going from maybe $60-odd million in 2025 to over $10 billion in the early 2030s. That's the bull case.
A massive leap.
Massive. And you need to use a very high discount rate, maybe 15%, 20%, even higher, to reflect that immense execution risk we've been talking about.
So what does a DCF model spit out for ASTS?
Well, our educational model, playing with reasonable assumptions within that bull framework, yields a very wide estimated intrinsic value range, somewhere between, say, $35 and $65 per share.
35 to 65, that's a huge range.
It is, and that range directly reflects the profound uncertainty surrounding those key future assumptions. It highlights just how speculative this investment is.
So the model doesn't give a single right answer.
Not really. Its true utility here isn't the final number. It's more about using it to reverse engineer what the market is thinking. The current share price, around $44.35, implies the market has already priced in a pretty significant degree of future success. It's not assuming failure, but it's also not assuming perfection.
Okay. So your investment decision then comes down to, do you believe the chances of them pulling off this ambitious future are better or worse than what that $44 price tag implies?
That's the crux of it. It's about probabilities versus the market's current bet.
Fascinating. Okay, let's transition then into part 2, starting with chapter 4. Market sentiment. How is the market feeling about ASTS?
Well, it's incredibly polarized. You look at Wall Street analysts covering the stock, and the sentiment is overwhelmingly bullish. The average brokerage recommendation is a strong buy, about 1.25 on a 1 to 5 scale. 87.5% of firms covering it rate it a strong buy. Pretty unified front there.
Okay, analysts love it. What about their price targets?
They range quite a bit, from a low of $30 up to a high of $67.20. The average target tends to hover right around $43 to $44.
So remarkably close to where this stock is actually trading now.
Exactly. Suggests analysts think it's sort of fairly valued at the moment, but they see significant potential upside if the company executes. And the media tone has definitely shifted more positive through 2025. All those de-risking events we talked about, the India partnership, securing the spectrum, new capital, Google investing, even chatter about Amazon.
Those catalysts have driven the stock price up quite a bit recently.
They have. But here's where it gets really interesting. The other side of that coin.
Okay.
In stark opposition to those bullish analysts, the short interest in ASTS is exceptionally high.
How high?
Depending on the source, somewhere between 19.4% and a staggering 28.56% of the free float the shares available for public trading.
Wow, nearly a third of the float being shorted. That's huge.
It's massive. It indicates a large, deeply entrenched group of investors who are actively betting against the company succeeding.
So what does that mean practically? High potential for volatility.
Extreme volatility, yes. With about 4.1 days to cover the time it would take for all short sellers to buy back their shares based on average volume, a short squeeze is a distinct possibility.
Meaning any significant positive news could force shorts to buy back quickly, driving the price up sharply.
Exactly. This polarization is really the defining feature of the ASTS investment case right now. The market is effectively at war with itself. Guarantees a bumpy ride.
And yet, despite all that short interest, the stock price itself is actually trading well above its moving averages.
It is, significantly above both its 50-day and 200-day simple moving averages. That indicates a strong uptrend in the short to medium term, technically speaking.
But you'd say that momentum is driven by news and speculation, not fundamentals yet.
Absolutely. It's narrative-driven, fueled by positive headlines and speculation about future milestones. That makes it inherently less stable. If those catalysts fizzle out, or if there's any hint of a delay in the manufacturing or launch schedule, that momentum could reverse violently, and the high short interest could actually accelerate the downside in that scenario.
A real knife edge then.
Oh.
Okay, let's unpack Chapter 5. Ownership structure. Who actually owns ASTS?
Well, institutions play a big role. They hold somewhere between, say, 34.5% and 49% of the outstanding shares. But what's really noteworthy is the type of institution.
Meaning?
The top holders aren't just typical mutual funds or hedge funds. They include major strategic corporate partners, Rakuten Group, Alphabet, that's Google, AT&T, Vodafone.
Ah, the MNO partners and Google.
Right. They hold substantial equity stakes, so their interests are aligned not just as future customers, but as owners too. That smart money is a core pillar for the bull case. It's strong industry validation.
Okay, that makes sense. What about insiders, management ownership?
Also exceptionally high. The founder and CEO, Abel Velen, holds around 25% of the company himself. Total insider ownership is cited anywhere between 32% and maybe even up to 62%, depending on how you count.
So significant skin in the game for leadership.
But on the surface, yes.
Huh.
But this brings us back to that important nuance we discussed earlier.
The insider selling.
Exactly. You look at recent open market transactions by insiders, and while one director made a small buy, the overwhelming trend among the top operational executives, the president, COO, CTO over the last 6 to 9 months has been consistent selling. Over 212,000 shares sold by them collectively.
So how do you reconcile those two signals? Strategic partners buying in, operational leaders selling out?
They're not equivalent signals, really. Strategic partners invest for multiple reasons. Sometimes strategic access is as important as financial return. But the persistent selling by the highest level technical and operational leadership, while the company is publicly projecting extreme confidence, that's a potent cautionary flag. It suggests those who know the true day-to-day difficulty, the real operational hurdles and timelines best, are choosing to lock in some gains or diversify their personal wealth. It warrants caution.
And overall ownership, is it spread out or concentrated?
Highly concentrated. The top 6 shareholders control over 54% of the company.
What are the implications of that?
Well, in the build-out phase, it can be good, aligns interests, allows for decisive action. But it also gives this small group immense control over corporate strategy and major decisions down the line. That could potentially disadvantage public minority shareholders if interests ever diverge.
Okay, clear picture on ownership. Next, let's dive into Chapter 6. Risk assessment. Let's pull it all together.
Right. A classic SWOT analysis helps frame this. Their strengths are pretty clear. Pioneering technology, that big IP portfolio, the blue-chip strategic partnerships, and visionary leadership.
And the weaknesses are just as clear, aren't they? Pre-revenue status, the high cash burn rate, massive execution risk, and obviously strained financials currently.
Exactly. Then you have the opportunities. Huge total addressable market, those growing government and defense contracts look promising, and the potential for a real first-mover advantage if they execute.
But the threats loom large. Intense competition from deep-pocketed players like SpaceX and potentially Amazon. Complex regulatory hurdles that could cause delays. Political risks.
And don't forget the risk of just catastrophic technological failure. A launch goes wrong, a satellite fails to deploy properly. That would be devastating.
Yeah, space is hard. What about bigger picture risks? Macroeconomic stuff.
Oh, absolutely direct threat. High inflation. That directly increases the cost of satellite parts, labor, leads to budget overruns.
And interest rates.
Higher rates make it more expensive for them to raise the huge amounts of capital they still likely need. Plus, higher rates tend to compress the valuation multiples for growth stocks like ASTS, whose payoff is far in the future. Both are headwinds.
Are there specific geopolitical things to watch too, like trade issues?
Definitely. Take the 2025 U.S. imposed tariffs, for instance. A new 22% tariff on certain key satellite components that could add maybe $7 million to $12 million per launch cycle.
Per cycle. Wow.
Yeah. Extrapolate that across the entire planned constellation. It could increase their total capital need by hundreds of millions of dollars. That directly shortens their financial runway, potentially forcing them to raise more money sooner, possibly on worse terms.
So if you connect all these risks, competition, regulation, tech failure, macro factors, funding, what's the single biggest threat?
It really feels like the company's greatest threat isn't any one of those things in isolation. It's the calendar itself. Time.
Time is the enemy.
In a way, yes. Every single risk factor gets worse, gets amplified by the passage of time. Competitors like Starlink aren't standing still. They're launching constantly. Regulators move at their own pace, often slowly. And ASTS's cash balance, while substantial now, is a finite resource ticking down every day.
That raises a critical point for investors, doesn't it? Unlike a nimble software company that can pivot easily.
Exactly. ASTS is locked into this multi-year, multi-billion-dollar hardware construction project. There's not much room to pivot. Every week, every month of delay increases that cash burn and allows competitors to gain more ground, potentially launch more satellites, sign up more partners.
So the primary risk metric investors need to watch is simply, are they hitting their deadlines, their manufacturing and launch schedule?
That's arguably the most critical thing to track, adherence to their publicly stated schedule. The calendar really feels like the ultimate arbiter of success or failure for this incredibly ambitious venture.
Okay, we've covered a lot of ground. Let's bring it all together in Chapter 7. Conclusion.
Right. This deep dive into AST SpaceMobile, it really reveals a company of profound contrasts, doesn't it? It's truly one of the most compelling, but also one of the most polarized investment cases out there right now. It's a story of just immense ambition, potentially groundbreaking technology, and absolutely binary risk.
So let's recap the bull case. What are the core arguments for optimism?
It really rests on the sheer scale of that total addressable market connecting billions. The technical validation they've shown with prototypes like Blue Walker 3, the creation of what could be a durable competitive moat built on that IP portfolio and secured spectrum, and of course the credibility lent by that consortium of blue chip partners, AT&T, Google, Vodafone, all led by a visionary CEO who has had a successful exit before.
Okay, compelling.
Uh,
But the bearish case is equally strong, isn't it?
Equally compelling, yes. It centers on that binary execution risk. It either works spectacularly or it could fail dramatically. The extreme valuation for a company with essentially no core revenue yet, the immense and ongoing cash burn rate, formidable competition, especially from SpaceX with its launch advantage. And you can't ignore those concerning insider stock sales as a potential red flag about internal confidence versus the public story.
And connecting back to valuation, that DCF model gave a wide range, 35 to 65 cents.
Yes. And what's fascinating, or perhaps telling, is that the current market price, around $44.35, falls squarely within that wide range.
What does that suggest?
It suggests the market has already priced in a significant probability of them achieving commercial and technological success. It's not priced for failure, but it doesn't seem to be priced for a flawless best-case scenario either. There's still risk acknowledged in that price.
So what does this all mean for you, the potential investor? What's the takeaway?
The key takeaway is that an investment in ASTS is not a traditional value play. It's much more like a venture capital style bet on profound technological disruption. The outcome is likely to be highly binary. Success could genuinely lead to multi-bagger returns, multiples of the current price. Conversely, significant delays or major technical failures could lead to massive shareholder dilution, or even, in a worst-case scenario, a complete loss of capital.
So definitely not for the faint of heart.
Absolutely not. This stock is only suitable for investors with an extremely high tolerance for risk, a genuinely long-term investment horizon, think years, not months, and the emotional fortitude to withstand extreme volatility along the way. Because the ultimate value of AST SpaceMobile won't be determined by analyzing its past financials. It will be determined purely by its ability to execute on its breathtakingly ambitious plan over these critical next 18 to 24 months. That's the time frame to watch.
Wow. This deep dive into AST SpaceMobile really does highlight that razor's edge between groundbreaking innovation and just immense risk. It forces you to really consider a future where dead zones are maybe a thing of the past. We sincerely hope this deep dive has given you a clearer picture of this very high-stakes venture. And remember, if you want more deep dives like this one, especially on tickers that you care about, please do like this video and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on tickers suggested in the comments for just €4.99 a month. It's a great way to support the channel and get your questions looked at.
And just the standard but important reminder, this analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be considered financial advice. Please always conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions. Your capital is at risk.
So as you go about your day, here's something to think about. How fundamentally would your daily experience change if mobile dead zone simply ceased to exist? What stands out to you as the biggest potential game changer, or maybe the biggest hurdle, for a company like AST SpaceMobile? Let us know what you think. We'll see you in the next deep dive.